Hey everyone, it's Harry, your host. Breaking. The US dollar is falling fast. Banks are sitting on hundreds of billions in unrealized losses. And the White House is signaling little concern as the currency slides, and the world is now pulling the rug out from under the US. The dollar's going to collapse. The dollar is going to be replaced by gold. Central banks are buying gold to back up their currencies. They're getting rid of dollars. They're getting rid of treasuries. We are headed for an economic crisis again that will make the 2008 financial crisis look like a Sunday school picnic. The biggest difference between the crisis that we're about to have and the one we had back then is this one is all in America. It's not going to be exported to the rest of the world. It's not a global financial crisis. It's an American financial, Mr. President, with the current value of the dollar. Do you think it's declined too much? No. I think it's great. I mean the value of the dollar. Look at the business we're doing. No dollars. Dollars doing great. What you just heard shows the sharp contrast in messaging. On one side, warnings that confidence in the dollar is weakening and financial stress is building inside the US system. On the other, the president dismissing the decline and framing a weaker dollar as acceptable. So, let's slow this down and talk through what's really happening. Why the dollar is falling right now. What this means for everyday people, especially when it comes to prices, savings, and financial stability, and then clearly walk through what you can do if this trend continues. The first thing to understand is what we actually mean when we say the dollar is falling. In simple terms, the US dollar is losing value compared to other major currencies like the euro, the British pound, and the Japanese yen. That's measured by the US dollar index, which has dropped sharply over the past week and is now at its weakest level since early 2022. This move didn't happen quietly. The dollar has lost roughly 2.5% in just 1 week and more than 10% over the past year. For a global reserve currency, those are meaningful moves, which is why markets reacted so strongly. A key trigger was messaging. After President Trump said publicly that he wasn't concerned about the dollar's decline and described it as great, the dollar fell further. Currency markets are extremely sensitive to signals from leadership. When investors hear that a weaker dollar is acceptable policy, many take that as a cue to keep selling. That doesn't mean the dollar is collapsing overnight, but it does signal that confidence is being tested. From the administration's perspective, a weaker dollar can have advantages. It makes U.S. exports cheaper overseas, which can help American companies compete globally. When foreign profits are converted back into dollars, revenues can look stronger. This approach isn't new. Other countries have used currency weakness to support growth, and President Trump has often argued that the U.S. has been disadvantaged when trading partners devalue their currencies. The trade-off is what happens at home. When the dollar weakens, imports gradually become more expensive. That pressure doesn't show up all at once, but over time, it can affect prices on everyday goods, from electronics and vehicles to clothing and certain food items. This is one reason analysts warned that a weaker dollar can add pressure to inflation. A weaker dollar can also make U.S. assets less attractive to foreign investors. That matters because the U.S. relies heavily on global demand to help finance government spending. This is where the banking system enters the picture. U.S. banks are currently holding roughly $337 billion in unrealized losses on investment securities, largely tied to bonds purchased when interest rates were much lower. As rates rose, the market value of those bonds fell. These are paper losses, not realized losses. Banks don't have to take them unless they sell, but they still matter for confidence. We saw in 2023 how quickly stress can build when depositors move money and banks are forced to sell assets at a loss. Today's banking system is stronger than it was in 2008, but the combination of a falling dollar, large unrealized losses, and uncertain policy direction is why markets are watching closely. At the same time, another signal has been flashing: gold and silver. As the dollar has weakened, gold and silver prices have surged to record levels. Gold has moved to historic highs, and silver has jumped sharply as well. This isn't random. When the dollar loses value, precious metals often become more attractive. They're priced in dollars, so a weaker dollar can boost global demand. Investors also tend to move into gold and silver during periods of uncertainty, viewing them as a way to preserve value when confidence in paper currency softens. Central banks around the world have been increasing gold purchases too. That doesn't mean the dollar is being abandoned, but it does suggest that governments and investors alike are hedging their bets. Up to this point, we've covered what's happening and why it matters. Now, let's focus directly on what you can do. The goal here is not panic and not dramatic moves. It's protection and stability. Start with awareness. Know where your money is sitting and how it behaves when inflation or currency weakness shows up. Long-term cash that earns very little can quietly lose purchasing power over time. That doesn't mean eliminating cash. It means being intentional about how much you keep parked there. Diversification matters. Relying on one single type of asset or account can increase risk when conditions change. Many people reduce that risk by spreading savings across different types of accounts instead of concentrating everything in one place. This is also where gold and silver may come into the conversation, but carefully. Gold and silver are often used as a hedge, not a replacement for savings or income. Many financial professionals suggest keeping any exposure modest as a small slice of an overall plan rather than a major shift. Gold tends to be more stable, while silver can be more volatile. There are also different ways to get exposure. Some people use funds that track metal prices inside brokerage or retirement accounts. Others prefer physical coins or bars which come with storage and insurance considerations. The key is understanding that precious metals don't generate income. They're about protection, not growth. One additional thing that often gets overlooked is taxes. Depending on how metals are held, gains can be taxed differently than stocks or bonds. That's another reason not to rush in without understanding the structure. Debt deserves attention as well. Variable rate loans or upcoming refinances can become more expensive if inflation pressure returns. Knowing which debts are fixed and which could change gives you more control and fewer surprises for people on fixed or semi-fixed income. Flexibility in spending becomes more important. Prices don't rise evenly, and small adjustments made earlier can help reduce stress later. None of this requires extreme action. The focus is preparation, not prediction. Markets will keep watching the Federal Reserve, trade policy, government spending, and future signals from leadership because currencies don't move on numbers alone. They move on confidence. And the real question now is whether this weaker dollar remains a controlled adjustment or whether it slowly reshapes prices, savings, and financial decisions in ways people only recognize after the impact has already set in. Thank you for watching.